Good morning, everybody. We're just going to give it 30 seconds for attendance to trickle into the room, and then we'll get started. All right, good morning. Welcome to the July webinar update with SevenBridge. I think everybody on the call should know me. I'm Justin Ferraccio. I'm one of the partners here at SevenBridge. This is
Hey,
Chuck Eberly.
good morning. Welcome, everybody.
So just a quick reminder, we're using this kind of webinar in place of doing a newsletter, right? So this is meant to be kind of a monthly look at some of the stuff that we're thinking about. Always feel free to invite friends, family, anybody else you think might find this interesting or just for the entertainment value. Um, we're going to go through again today, and it's going to feel a little bit repetitive, but we're going to talk a little bit deeper about AI, just because it continues to be the question that we get most, and it is by far the thing that Chuck and I and our team are paying attention to the most. So we think this is the most important topic to discuss,
Yeah.
right?
One thing the question we get a lot about it would be, like, do we have AI? Are we participating in it or how are we participating in it? So today we're going to kind of break down the components of AI, what they mean, how they're reacting to different events. So that's the purpose of today is to kind of, parse it out a little bit instead of lumping it into one big blob called AI, break down the components.
Correct. Yeah, because it does kind of break into three components pretty cleanly. And those three components affect a lot of different areas of the market. And so we'll dive in. I'll share my screen and we'll get going. Perfect. So again, we'll kind of go through normal stuff. I did the introduction. That was riveting. We'll do a quick market update, what's going on with the markets. And then we're going to dive into AI's role in the bull market. We're going to talk about the influence of AI in the three kind of different sectors that we've identified. So that would be receivers of capital, spenders of capital, and then software as a service. We'll go a little deeper into kind of how sectors have performed this year in the economy. We're going to look at the value of the market and if we think it's overvalued right now. And then we'll quickly show you an earnings calendar, which is something that we pay attention to and thought you might find it interesting. So these numbers are as of market close yesterday. Dow is up nearly 8% on the year. S&P 500 is up 8.8. I think the most notable thing to look at here is when we did this webinar in June, a lot of these numbers are very similar. The big change is the NASDAQ, which is more tech focused, AI focused type companies live in that index. That was up about 14.5% last month. It's now up 9.8% on the year. So we're looking at nearly a 5% drop in tech AI type companies over the last 30 days. And we'll talk a little bit more about that, but that's been the pullback. 9.8% halfway through the year is still remarkable. Very happy with that. But if you look at, you're wondering why S&P, equal weight, Russell, Dow, they're all about the same. It's really NASDAQ this pulled back. And just kind of a reminder, equal weight S&P, that 11%, that takes the 503 stocks in the S&P 500 and looks at them as if they're all equally weighted, which they're not in the traditional S&P 500. They're weighted by market cap. So you get companies like Nvidia that are 8%, Google 7%. So they're much heavier weighted at the top. The equal weight says, what if everything is exactly the same? Weight them the same. It's up 11%. It's outperforming the S&P. What that tells us is the broader market participation, industrials, energy, those types of things that have boosted up that equal weight and it's causing a little bit of outperformance there.
Don't forget the bonds.
Yeah, bonds are down 2% year to date. They were down 1% last month. So in the last 30 days, they've dropped another percent. It's because rates have kind of have gone up again. Something we'll continue to monitor, but bonds continue to be a challenge in this market.
Yeah, for sure. I think, yeah, there's a lot of talk about the Federal Reserve raising interest rates. That has a lot to do with inflation, has a lot to do with uh, the growth rate of the economy being good, earnings being good, GDP looking good. So remember, the Federal Reserve controls the short-term interest rate. The bond market is what, when you see that minus 2.1, that's the bond market, the rates going up in the 10-year, the 30-year, the things that the bond market controls that the Fed doesn't directly. Indirectly, they do.
Correct. So just a quick look at sector performance, right? So we kind of track, these 11 sectors of the economy. Um, what's not done well this year? It's healthcare, it's consumer discretionary, it's financials. What's done really well this year? It's technology, energy, industrials, materials. So we kind of point this out, because we do get questions about, people look at their portfolios and their healthcare companies are down or their financial service companies are down. Why do we own them? So it's just a kind of a quick reminder that you know, not all that sectors don't all move together. They can't, right? So if it was just a linear approach, that would mean we were too overweight in sectors. They're inversely correlated. Some are designed to do well when others are doing poorly. And it's important to kind of keep this allocation that we have in place for our clients because it does give us diversification. If there is a pullback in the AI trade, it's going to come from tech. It's going to come from industrials because they're directly supporting the AI movement. Healthcare, consumer discretion, financial services will be the beneficiaries of those pullbacks a lot of the time. So it's just kind of important to look at this holistically. And then, from a point of view that we look at, most of our clients are underweight technology compared to the S&P 500's 35 to 38% tech. Most of our clients are 18 to 25%. Everyone's a little bit different. Some people are, fully at that 35, 38% mark, but very few. But it's also important to note that tech companies that we've owned this year have outperformed substantially. So we're getting returns in tech that we would expect to get even if we owned the full allocation. But some of the things that have helped us this year is, energy has done well. Energy is only 2.5% of the S&P 500. Our book, we're about 5.5, 6%. So we're heavier energy, we're heavier industrials, we're heavier utilities. So we've kind of overweighted a couple of sectors of the economy that have done well. And the sectors that we're underweight in, we've been fortunate to pick the right companies this year to get the returns.
Yeah, I think when you think about your own account and you look at a day that the market's down or a month that the market's down, and you look at your portfolio and see that you didn't fully participate in that downward movement, it's because of this sector diversification. That's what helps us when things are not cooperating. Diversification by sector, which is key to our strategy. That's what holds us up. And it really hasn't held us back with performance. Because if you look at the performance of your account, we're getting an S&P 500 type return with not all the money necessarily in stock, underweight in technology. So, we see this as the key to diversification, the key to protecting your assets, but also the key to getting good returns.
Great. So we'll do a little bit of a deeper dive into AI market influence. Right. So it's no secret AI continues to drive this bull market. It's been the key driver for 3 years in a row. And it's visible in all the major indexes when you look at them. Like we talked about a minute ago, technology leads that by a wide margin. It continues to be the best performer of any sector, and it's been like that for years. But we are starting to see broader participation now, and we've seen that all year with industrials, with other sectors of the economy that have done extremely well, and they're participating, right? So it's part of our job to untangle are companies participating because they're somehow directly linked to AI, or are they participating because, of other reasons? And we'll get into that a little bit deeper here today as well. So this is kind of the main thing that we wanted to get deeper into today, right? Because we often talk about AI. We talk about, we get questions, are we participating in AI? Do we own too much AI? What happens when AI falls? Are we gonna lose, money in our portfolio? And so that this term AI has become this broad term when it's really not, right? So that there's three different kind of distinct parts of the AI market. There's receivers of capital, there's spenders of capital, and then there's software companies. So when we think of receivers of capital, we're talking more about memory companies, semiconductor companies, cloud storage companies, power companies, water companies, utility companies. So these are, companies that are receiving capital and growing their businesses and doing really well right now. So you look at semiconductors, those are chip makers. So companies are pouring money into chip makers because of supply and demand, and they need more memory, they need more semiconductors, need more chips, need more storage, need more power to power their data centers. Those are receivers. Spenders of capital are the biggest, richest companies in the world. Those are the Mag 7. Those are your Nvidia, your Google, your Meta, right? Those are the companies that are once were cash generating machines, and now they're making the biggest bets they've ever made in their lives, right? So these are companies that have always consistently had huge, huge free cash flows, and they still do. But now they're taking their free cash flows, spending the money to buy more data, buy more memory, buy more chips, build data centers, procure more power, right? All these different things that they're doing, they're making a huge bet that if they spend more money, they can grow their business in the long haul. And then you have software companies. So that's a sector that's kind of experienced a big switch recently. People originally thought software companies were going to be a big beneficiary of AI, and now they're viewed as largely vulnerable to AI. Those are your companies like Salesforce, ServiceNow, right? Companies that Microsoft you could put into this bucket. They're building software, and now people are looking at them thinking, can AI replace what they're doing? Right? So those growth-driven valuations have become more susceptible. And then that sector kind of splits into two, right? And the other one would be more companies like CrowdStrike, right? So it is a software company, but it's more disrupted, and we'll talk about that here in a minute as well. And then I'll just quickly touch on the receivers of capital, right? So these are going to be companies that are doing memory, semiconductors, data centers, constructions, real estate, utilities. So that's companies like SanDisk, Applied Materials, Intel, Micron, Quanta, which is ticker PWR, Nextera, right? So these are, again, companies that the Mag 7 are pouring money into to build infrastructure, build memory capacity, semiconductor capacity.
It's me.
I'll let you take it. I've been talking too much.
Okay, so you see that 106% increase. That's the cost of memory. You think about your home computer having RAM, um, random access memory, that the cost of that has gone up. But you think about AI and the memory that is needed for that is so much larger. But if you think about I don't know, the cost of oil going, more than, doubling. And you look at the profits or any product for that matter, um, that's part of what's driving it is the scarcity of memory and the price of it going up. And as you'll see, it's really driving a lot of the earnings that we're looking at. So, the driver is it's, basic economics, supply and demand. Too much demand, not enough supply, prices going up, earnings going up is a big part of what's going on. Um, the spenders of capital, when these are the companies, the Mag 7 that we talk about so much. Um, these companies, a lot of what they're doing now is integrating these different components in-house internally, and especially Google, which they report today,
Tomorrow.
So, when we're not looking at what earnings are coming up, but that's going to be a good thermometer of what's going on as earnings are coming out here real soon. But these are the names when you think of spenders of capital, the ones that come to mind.
Again, these are the guys that have been the biggest, biggest beneficiaries, biggest growers in the last 3 years. And now they're the ones being the biggest spenders, right? So this is where the market was excited for a long time that Nvidia, Apple, Meta, Google, Amazon, Tesla, Microsoft are pouring money into investment. Everyone was excited about that. People are still excited, but now people are starting to wonder when and how are they going to get returns from the spend? What does that look like? And that becomes the next roadblock in this, AI trade, this AI, movement is how do these companies turn this investment into profit?
Yeah.
And
A lot like the dot-com era, when, we're all excited about it, but then, a lot of money being spent on building it out. But then the next part of it is, are the companies going to make money on the investment they made? That's the question. Um, Valuation takeaways. If you look at the performance, you can start to see some of the companies, they're proving it out. Microsoft, if you look at them, um, their performance is negative on the year. So there's an example of a hyperscaler that there's more questions about the spend that they're making. Are they making it in the right places? You look at NVIDIA and other semiconductor stocks, they've been extremely strong. Um, I mentioned Google, they're starting to integrate, building their own chips, their own cloud, starting to integrate all these pieces internally within um, Google as a company, but it's starting, the good news is that it's showing maturity in the AI market, that things are starting to come together. And going back to infrastructure, you look at like Quanta is a company that most of you own. You know, that's an infrastructure play in data centers. So you look at Caterpillar, you look at Cummins, those are ancillary companies that are receivers of capital. So if the spend starts to slow down, that's not a trickle down to those other companies. So it's not just the main tech names. There's a lot of industrial names and utility names that all this has trickled down to, which if the spending slows, they'll be impacted. Their earnings will be impacted. So we think about software as a service. Software in general has, they've thrown the baby out with the dishwater or with the bath water. Um, that they kind of all got lumped in one group that all software is bad because AI is going to kill it, which is not the case. And now we're starting to see ones that, like CrowdStrike in particular, a cybersecurity software company. Um, what really hasn't been thought about too much is how will AI help these companies, um, the right code and to be more profitable. So they kind of look at it, AI will replace them all, which is not true. So we're starting to see, different winners and losers in this whole group, which we really don't have a lot of exposure to across the board. Um, Valuation takeaways, the return data, with the software companies, um, has been mostly negative. So we break these into two groups. Traditional app-based software, if you think about Salesforce, ServiceNow, those are kind of in the group that is still not proven out whether it'll be a good thing or a bad thing. But infrastructure, CrowdStrike is an example, that's starting to show that there will be benefits from AI for those types of software companies. So our stock's overpriced. Right now, the S&P 500, if we look at forward earnings, is selling about 20 times. And I think the last webinar we talked about this, that um, we think about traditional valuations of the S&P being 15, 16 is fairly valued, and now we're sitting at 20. Um, the the way these indices are composed has changed. There's a lot of tech companies, even with the Dow, a lot of tech companies make up the Dow, that those companies have much more earnings growth than these indices, say 20 years ago or 25 years ago, when they were mostly industrial companies. So I think that metrics has changed a little bit, but you look at 2026, earnings are growing at 24%. So the earnings supports the high multiple. Semiconductor earnings are growing at 130%. So we have explosive growth, and that's really what's supporting the markets right now. Something to keep in mind, that last bullet point, Micron and Nvidia, if we pull their earnings out of the S&P, it takes the earnings growth down to 16.8. So still very strong. A typical earnings growth rate for the S&P 500, the average is 7. So we're more than triple a normal earnings cycle. So if you ask yourself, why is the market trading where it is? It's because of earnings growth.
Yeah. But even on the forward-looking PE, we did kind of parse this out. The 10-year average is 19 times. So we're at 20.3. So market's not cheap, but it's also not completely out of line. It's a little bit higher than normal, but it's nowhere even close to where what kind of forward-looking earnings we were looking at during the dot-com era, right? So it's still very much in range. Like Chuck said, earnings supports the PE ratios completely right now. So now it's just, continue to watch and continue to make changes when it's appropriate.
It's rich, but not crazy.
Correct.
Um, Earnings report. So we have a bunch of earnings. We're not showing the calendar, but this is kind of an example of, I'd say, things working out. The receivers of capital, their spending remains strong, supports continued growth. That's the good side. The bad side would be that, that spending growth that they're receiving slows down. And that's what we're watching as far as when all these earnings are coming in, are they reporting that they're going to be slowing going forward, or did they slow it down in the previous quarter? Same with the spenders, are they generating returns from what they are spending? Are we starting to see rewards from that spend? And then, with the software companies, which ones are really benefiting from AI and which ones will be disjointed, and kind of parsing through that.
So we don't expect you to track all these, but this is something that we pay attention to. So I just wanted to kind of show you a quick earnings calendar of receivers, spenders, and SaaS companies. I think the most notable ones coming up, we have Google tomorrow, and then that kind of leads into next week, Meta, Microsoft, and Amazon. So within the next, 10 days, we have pretty substantial earnings reports coming out. NVIDIA is pretty far away. And then kind of, again, end of this month, software companies, something to pay attention to. We don't really own many software companies right now in the traditional sense, companies like ServiceNow, Adobe, um, Salesforce, but we do own some companies in that space that would be more in the CrowdStrike type world, and then a few of those. But we're paying attention to this. Tomorrow is a big day with Google. That kind of leads into, you know, really four of these hyperscalers within a week period. So we'll be paying attention and making changes if needed.
One thing to keep in mind is there'll be an earnings announcement and it'll be very good, and then the stock will go down. So a lot of times it's kind of the opposite of what you would think, but it's really digging into what they're reporting and what it means in the future. And always keep in mind that the stock market is a leading economic indicator. It's trying to figure out what things are looking like, 18 months out. So even though the news seems like it's reactive, it's actually discounting the future. So that's a hard thing to keep in mind. And it's the earnings reports, it may show that they did wonderfully and the stock goes down, which doesn't make sense, but it happens all the time. Or it's negative and the stock's up. So
Yeah, it's all about expectations, right? Even if a company comes out and beats, guidance by 50%, you look at that like that's amazing. Stock goes down 5 or 6%, right? Because the analysts in the market might have been pricing in an expectation of a 60% beat or whatever the numbers might be. So it's all, worth paying attention to. But we'll do it from our side as well. And
there'll be plenty of news for action
yes,
coming here soon.
if anybody has any questions, you can drop them in the chat now. If not, just feel free to reach out to Chuck and I. We'll get back with you today and we'll go through whatever questions you might have, but I don't see anything coming in. So we'll go ahead and give you back 3 minutes and everyone. And I think we were really supposed to be 15, so we stole some time from you, but we appreciate you spending time with us. Again, we kind of felt like we're being repetitive with AI, but we really strongly feel this is the most important thing that we're paying attention to. And this is where we're getting the most questions. So we're going to continue to focus on where people want us to focus. If there's something else you want to hear about, you have a good topic, send it over to us. We're probably going to be doing an estate planning webinar in the next 1 to 2 months. So we'll make sure that when that email goes out, you'll see what the subject is in the agenda. But that will be an interesting one and valuable for most of you on this call.
Then we'll have guest speakers.
Yeah, so you don't have to listen to us. Win-win. All right. Thank you all. Appreciate you spending time with us, and we'll talk soon.
Thank you.
Bye.
Bye.